All right, everybody. Hey, we are back from our break and just absolutely excited for this next hour 50 we go to with our next guest here. You never know what comes from an email blast. And I think about 3-4 years ago, I sent an email blast out to special asset managers that I have and got a response. And we have been communicating ever since about different things on a every 6 to 12 months basis here. And the guy I'm talking about is the guy is going to share some nuggets with us. We kind of go back and forth here. Is Yakhin Israel out of Tampa, a previous special asset manager for a major bank who's left the banking side and has gone out and become a commercial broker on his own regard, doing a great job in Florida. So big round of applause. Join us today here. Drum roll, please, everybody. Hey, man, we are so honored to have you today. How's everything going?
Everything's well, and thank you for having me.
Yeah, man. So why don't you share a little bit of your background, kind of where you, kind of your footprint, and kind of where you've been and kind of where you're at today, and we'll dive into a little bit more information.
Sure. I started in commercial finance right out of college, 2002. Worked for a commercial bank, Fifth Third Bank, originally from Lexington, Kentucky. So that's where I started right out of school. And from there, really kind of learned the fundamentals of commercial real estate or commercial finance, period. But definitely real estate, business, just about everything you can think of. We had a horse country in Lexington, so I got to see a little bit of horse farm finance, but you never know where those experiences take you. And frankly, having and understanding the underlying business, obviously the cash flow for commercial real estate in most cases has been helpful. Started actually in commercial real estate in 2005. And so it's been, 14, almost 15 years in commercial real estate specifically. Moved to Cincinnati with Fifth Third and started lending then. And ultimately how I got into the note segment, interestingly, was 2008. As I'm sure you said plenty of times to your listeners and followers, most lenders in 2008 de facto became asset managers after the downturn. How I got into it specifically was kind of self-driven. Essentially within the bank, you could kind of feel that the wind was blowing some way. We didn't know what way at the time. But I think that given a lot of conversations internally, I pretty much raised my hand in that I saw opportunity to start selling performing loans, small balance loans. Banks, like Fifth Third, grow via acquisition. There's a lot of legacy loans that are great loans, great borrowers, et cetera. It just, and many times they may not ever borrow again, or just their alignment as a borrower may not align with the segment that the bank has going forward. So there are always opportunities, not only at the asset level, but just as banks change their balance sheets to look for opportunities to acquire loans. So I went to my manager at the time, told him that I thought I could sell performing loans to community banks. Because at the time there were a lot of money. A lot of community banks were flush with cash, couldn't originate fast enough. We had these loans that were pretty much locked in at pretty good rates from a banking standpoint, great clients. And so I had the opportunity to take on, call it 80 to 100 loans, average balance $1 million, $1.5 million, and personally look at the portfolio, look at the loans that I thought were best opportunities, and ultimately sold those loans to community banks, and in many cases went to borrowers directly and gave them the opportunity if they wanted to refinance or they wanted more capital or another capital partner, introduce them to some of the community banks. So did that by the end of the year. We started that in like March, first closing was August. So by the end of the year, it was probably 23, 24 million, not a lot. But at that point in time, knowing what we know now was pretty significant.
Yeah.
To be able to sell those loans, and ultimately because it was bank to bank, that was a par sale. It was not a discounted note, primarily because of the need, I think, on Fifth Third to kind of remanage its balance sheet, combined with the opportunity for other lenders that needed loans to take on some more loans. I think personally could have gotten a premium probably, but great opportunity and great experience. After that, in 2009, had the opportunity, the bank at the time was pretty unique in that they decided to create a full team internally to sell its notes and sell its non-performing assets kind of post-downturn. Many lenders decide they want to hire a loan broker. Many of the brokerage shops, CBRE, where I'm employed now, HFF, First Financial Network, Mission Capital. There are a lot of these, at the time, loan sale advisors that were all pitching for the business. Fifth Third made the strategic decision to just build out. It was an opportunity, I guess, to keep some of the lenders employed, and it was also an opportunity for everyone to kind of learn, why, outside of the general economic environment, why specific loans, did not do as well. And it was a great learning experience. So I moved to Tampa sight unseen in 2009 to start selling non-performing loans. As you can imagine, those conversations and processes were a little bit different than on the performing side. So
you're like at ground zero in Florida, too, in Tampa, right?
Literally. I had never been, outside of that, I'd been to Florida, Fort Myers in high school for a basketball tournament once, knew maybe 4 people in the state, but I'll tell you, I got a lot of new best friends at that moment, not knowing at the time that I was sitting kind of in a catbird seat for people across the country, funds, developers with not a lot to do because there wasn't a lot of activity. There were a lot of folks out there looking to buy notes. Mm-hmm. And it was our, kind of thoughts as far as people out there listening who want to buy notes. It's very much a relationship-driven business. Ultimately, it's very competitive. There's a lot more money than there are, any distress at any given time, especially now. And so, first advice, I guess, that I would give is to develop the relationships and understand the strategy before going in and engaging with any asset manager, because they have, now it's a little bit less, but then there was no less than tens and hundreds of people calling every day with a $100 million fund that they wanted to buy all of my notes and solve my problems, like right there. Obviously, you've got to weed through to determine, who's real, who has the ability to execute, who has the ability to get the price that I need to be able to satisfy the lender. And ultimately, it was pretty dynamic. But the bottom line in all of that is developing the relationships with those folks.
Yeah, I totally agree to that. I mean, that's the thing is you're getting bombarded. I mean, we still get bombarded all the time. Somebody called me today, I got $100 million to fund and we want to do it every month. And I just had to chuckle because I'm like, if that's the case, why are you calling me?
Right.
You would be on FFN, you would be on Mission Capital and some of those things, bidding on those things. You wouldn't be calling me. I mean, I'm a big fish in a small pond. You'd be dealing with big fish in big ponds at that point, right?
Correct. And interestingly enough, a lot of the former buyers, the funds, the large institutional funds, they're actually lenders now. Yeah. So fast forward, I spent 4 years doing nothing but sales of distressed notes. If they happen to convert to property, would be in the process of selling a property. I actually did 1 year in direct workout with borrowers, which that's the key. I mean, ultimately, if you're going to be a note buyer, the first thing you're going to look at is where you buy it, and what price that you buy it. But more importantly is the execution on how you're going to create value for yourself and your investors, on how you get to a resolution that gets you some yield. And so ultimately, that's truly asset management, what I was doing at the time. And it's going deep, working with the borrower, understanding why it went bad, seeing if there's a way to resolve it. In some cases, it may be just, getting the keys back. In many cases, it could be allowing the former borrower, to do what they need to do, finish their strategy. If you buy it at the right basis, maybe you give them a little bit of time. Whatever the strategy is, that's really the key after you buy it. So having that experience was pretty good, because I can now, honestly say I've lent money. I've, tried to get it back in many ways. I've sold assets. It's all kind of connected when you look at it at the end of the day. Mm-hmm. After that quick stint, and it was literally a year, I went back to origination in the Southeast for the bank. And that was, the footprint was pretty much the Carolinas, Georgia, Florida, which, as you know now, that along with the Sun Belt pretty much is where the growth is in the country for the foreseeable future. Obviously, coming from Kentucky, spending time in Ohio, the Midwest, you know, kind of northern border of the South, if you will, still has a lot of manufacturing, and you know, it's going to be pretty steady and stable. But when you look at where the outsized growth is and where the cranes are, it's, you know, cities like Atlanta, it's here in Tampa, it's Orlando, it's Charleston, it's Charlotte, it's Texas, just about every major city.
It's growing up big too, you know.
Nashville. And there's a lot of, you know, new incumbents when you kind of look at primary markets and who the real secondary and tertiary markets are. This last 10 years has been great to kind of watch the growth of these cities. So I did a couple years origination, basically going out, leveraging experience, because obviously everyone likes to hear from someone that has been in the trenches and understanding what went wrong. As a borrower, you want to kind of make sure you're understanding that. Obviously, I had money to lend at the time, and so it was great to build those relationships. I parted ways with Fifth Third in 2016, which gave me the opportunity to be fully entrepreneurial. So I went out and started kind of my own mortgage brokerage shop, Twin Pillar Capital. Did that for about a year, really same business plan, developed strong relationships across the Southeast with borrowers and other related folks. And probably, you know, halfway into my stint there was CBRE came calling, which was a great opportunity. Here in Tampa, there was an opportunity to join the firm and help to be a part of the debt and structured finance team here in Tampa, but basically execute the same strategy all over the Southeast. And so what I do currently is help borrowers, investors, et cetera, and connect them with capital sources. If that's debt, if it's mezzanine financing, if it's preferred equity. There are things like PACE financing that's out there floating around that's pretty interesting. And then we've got ways within the shop to provide equity as well for the right opportunities. So it's been great kind of run. And you can kind of see the line from a career standpoint. I've been fortunate to be able to draw on my most recent experience to move on to the next. And so that's kind of where I'm at now. I guess going back to an earlier point, a lot of the former buyers are now lenders. And so you hear about shadow lending or debt funds or private lending, or there's a number of names, but the reality is that there are a lot, you know, hundreds of firms that play outside of the space where banks play, places like, or in assets like land, value add strategies that have a combination of non-recourse and leverage, you know, high leverage. Strategies that may not be ready for a permanent lending box, you know, CMBS or Lifeco. There was a lot of money that had, rather than, you know, return that money to the investors, they literally pivoted, probably having a portfolio to kind of start from, and is now lending today to investors. Maybe depending on the size of the opportunity, could be great lenders for, you know, the folks listening here, because they started off from a foundation of understanding the fundamental asset underlying the loan. When they're lending now, they're looking there first. You know, what happens if something goes wrong, and have a good understanding of the underlying asset. And that's kind of key, you know, in general. And then they actually have terms and have some flexibility that, you know, many traditional lenders don't necessarily have. So they've filled a great space in the last 10 years. I think, frankly, if we have a downturn, it is my belief there's a lot more liquidity than there are, you know, distress that would potentially happen. Many of that distress would already be with the lenders that originated, and they've already got strategies to figure it out. But there are still opportunities on a one-off basis to always find assets. Yeah,
that's kind of where I was going to ask you. Is the next thing is, since you got your pulse on different markets there, where do you know, are you foreseeing a downturn in the next 6 to 12 months, or what do you kind of feel the market's going to do? I mean, I know you don't have a crystal ball, and that's the $1 million question, right?
Right. Yeah, literally, I would have a fund ready to go if I.
It's funny because we just had a guy an hour ago runs a big fund out of California saying the thing: socking as much money away as you can right now to raise capital.
You know, I guess my answer to that question, because literally it's been the last 5 years we've been trying to figure this out. I mean, this is not a new. Now, granted, every new day that we move forward, it's like, okay, it's coming. And inevitably, I guess we're going to be right. I'm more interested in helping people develop robust strategies for any economy, because as you know, the D's of finding this, assets, they're going to happen in any economy. Now, granted, we were fortunate, unfortunate, how you want to look at it from a no buying standpoint. If you were playing in that space, you probably have seen, hopefully, the worst, downturn that we will see in our lifetime. That's the hope, right? And so you kind of have a gut feel and an understanding of what that environment was like, and can operate going forward with some sort of data point of on any particular asset or a portfolio, kind of where the bottom would be.
Right.
Next 6 to 12 months are going to be interesting. You've got an election year coming up. CBRE does a really good job with its research. We know we had, the economic GDP was steady, not as much as projected. I mean, the projection was north of 3%. It's been 2% forever.
Yeah.
Consumer spending is still strong, even though manufacturing is down. A lot of that manufacturing has to do with the trade and tariffs. So there are any number of reasons why it could go either way. And so what I'm seeing real time on the ground is no shortage of development, redevelopment, particularly because I sit in the South. Just the sheer number of people. There are 1,000 people moving to Florida every day. Most of those folks are moving to places like Tampa and Orlando. So it's kind of like a different ground zero. This town, Tampa, since I've moved here in 2009, the next 5 to 10 years are nothing but, growth. Assuming that even with the economy, when you look at where the most growth is happening within that 2%, a lot of it's down here. Mm-hmm. It's industrial. The I-4 corridor is now a hub for Amazon and Walmart and Kroger. And, you can get from the port of Tampa to most of the country now without a stoplight. It's become amazing to see that piece of it. But then you've got, folks decide they want to live in places where you typically, vacation or retire. Why wait? A lot of that's been driven by the new folks coming out of college. You've got UCF and USF. UCF is one of the largest schools in the country. Orlando, which has historically been, obviously tourists, has become very strong industrial. Both Tampa and Orlando are working for create tech kind of hubs. And so folks are financial services. Folks are starting to move here. Obviously tax situations in New York, California, and other states, not having taxes, in Texas and Nevada and, Florida has been, net positive for those states. So every city that I go to, it's been very positive. A lot of growth. I just got back from Atlanta last night. Spent last week there working with a client who's doing a value-add multifamily strategy in the perimeter, which you would think today that's been, run several times over, but they've created a creative way to feed a pocket that I think most folks are overlooking, affordable on a price per pound basis as far as rents. Obviously, affordable housing is something that's going to be a challenge for the foreseeable future. Finding creative ways to provide that. And it's not always, I think a lot of times when people think affordable, they think like tax credit deals or, kind of government sponsored deals, which that there is a need there. But the reality is the workforce housing is what they're kind of calling it. Everyday people who are, working all types of jobs, teachers, firefighters, folks in the service industry. Many places in Florida, they don't necessarily live where they work. Yep. And many places, many cities across the country, it's becoming increasingly expensive to buy a home. And even, 7 years have passed from the downturn where credit might be repaired. And even now, the cost of buying a home, even with interest rates, where they are, seem to be impactful. So what I'm seeing is, multifamily is extremely strong in most markets. Industrial for the markets, like Atlanta, I-4 corridor. You've got things like storage, which kind of follow the housing, if you will. Some of the builders like D.R. Hortons of the world that are playing in kind of the lower end of the spectrum of pricing. They're very active, can't get lots fast enough.
Right.
Retail is interesting in that a few years ago, a lot of folks were, calling the demise. I just think it's been a transition. Some of it's going industrial and retail kind of merging. Seems that we seem to be going back to kind of a village concept where rather than going to a big box, people want the retail near them. Mm-hmm. They want to live in areas where they can walk outside or walk down the street and go to the grocery store or to go to the boutique shop. Looking at gym space, people aren't necessarily going to the big box gyms. They're going to the CrossFit gym. They're going to the Orange Theory. So it seems like it's kind of just evolving. And, those developers and investors that are finding creative ways to, maximize on those opportunities are winning. Mm-hmm. And, that's kind of what I'm seeing personally.
Are you seeing a lot with those developers that are going in and regentrifying, like you said, the big box, the Walmarts, the larger retail facilities that are really kind of going under? Because they expect a lot of those, those household names that have been around for years have been really struggling because they've not embraced the online model that Amazon and others are doing. That are you seeing more of that where they're maybe going in an old Walmart or an old store and regentrifying, the executive space or self-storage stuff or other things?
Yeah, I mean, I think what you're seeing is the J.C. Penney's of the world and whatnot. We're going through a big demalling, it seems like, across the country. The malls that are hanging around are really high end, or they really are very strong within their community. The areas that have multiple malls, there's probably going to be one, maybe one and a half that wins out, and the rest are, to your question. I've seen strategies where developers are coming in, buying the mall, maybe raising the big box and creating multifamily. They're looking at being more creative in the outlet spaces. People want to go and eat, in various different restaurant concepts that aren't always national. A lot of boutique restaurant, local concepts that are being developed that are going into the out parcels. Storage for a lot of the grocery anchored centers that that the anchor may go away. We've seen self-storage strategies. Medical use, doctors. I mean, obviously, if you look at if you look at the demographics and folks that are aging, they're needing, you're starting to see medical malls that are happening. So a lot of the uses you wouldn't expect to see in a retail setting, you're starting to see, partly because of the opportunity to get in at a low basis.
Yeah, I agree. We do have an aging elderly group, but especially there in God's waiting room in Florida for the sure. But that's the thing. Somebody asked a question. When you're reaching out to bankers or you're looking to start talking to asset managers, what are some things that they should or should not be doing? They can maybe let's talk about things they should not do. Things that when you've seen, you're just like have to shake your head like this guy's a joker, broker, and an idiot. What are some things that
try not to retrade? And I know retrading is very subjective. I think some folks, they come in a really low number and then come back. I mean, you can see it a mile away. I mean, ultimately, there is some resolution at some number. Where I typically have transacted has been someone that seems to know the asset, already has a strategy, already has a solution. They seem to be put together well, and they can prove that they can execute either because, hey, here's what we bought, or here's someone we bought from, and I can get comfortable, taking their offer into the decision makers and maybe cutting the deal. So I'd start there. Developing a relationship, there's a saying, you dig the well before you need it. Yeah. I think ultimately for those folks that are going to be in this long term and aren't just, opportunistic note sale buyers, I would try to, target specific lending institutions and develop relationships with those folks. May not always be the direct asset manager. I can tell you everyone that I know that was kind of my counterpart at every lender that I can think of, most have moved on. They're in commercial real estate sales, or they may be back in lending, or they're doing something else. So there's probably a new wave of people who come in, but I think developing the relationship with the institution, it might be lenders. It could be, if you have the opportunity to develop a relationship with the C-suite, it could be the risk folks. Doing that now before, there's a need or there's an opportunity, that would be my largest, piece of advice, because it is relationship driven. Coming in with a strategy, and actually providing a solution outside of just price. I think if you're going to compete on price, it's very competitive.
Yep.
I would tell folks to assume that every asset manager has 5 buddies who probably gets a first look. I don't know if that's really the case, but I think if you're making that assumption, you've got to get creative on your approach. What else do you have besides a purported $100 million fund that everyone else has? So you've got the money. What is it about the specific asset or the portfolio that would give that asset manager comfort that you're the right buyer? Because, obviously price is important. Certainly the execution is important. Your strategy post, because, it might be a borrower that is not necessarily a bad borrower. It could be a circumstantial situation where the best strategy would be something that to keep the borrower in tow and helpful. And if you're going to come in and pay the lowest price and ask for the keys, that might not be the best strategy for resolution. And so I think that, understanding, having a strategy, being well-versed in communicating that is helpful as well.
I'm going to clarify, when you say retrade, you're talking about, just for everybody's listening, people coming in with the idea of just getting a low ball offer, then retrading, trying to wholesale that deal to somebody else or to do a double closings. Somebody that's not looking to actually own or operate that or hold that paper in their portfolio. So that's what he means by retrade, Wayne. And for those else that had the question out there, good question though. But I'm curious for you, if somebody's coming to you with a resolution on a deal, they know the asset, and have you seen it where the bank was even willing to maybe carry the paper or move the paper from the non-performing side to the performing side of the books?
Very rarely. Typically, at least in my experience, if it's at that situation where it's in the distress, it's in, special assets, there's probably some fatigue, particularly back in 2000.
Yeah, of course. Right.
There, if it happens now, there's probably some, runway or some value there, underlying value, where there is, a good conversation. But typically, if it moves over and you're having discussions of a note sale, then there probably is not necessarily, the lender may not be available to provide capital. However, I have seen instances in which they were. Hey, you bring in a new, someone that's got fresh set of equity, someone that has maybe a different strategy than the current borrower, someone that may or may not be willing to work with the borrower. If it leads to a resolution that provides them with the best, price, and, it doesn't have any reputational risk for the lender, then, I think that, it's possible.
Yeah, that's a big thing. Reputational risk, I think some people forget about. The last thing a bank wants is to be splashed on the front news of the local news or newspaper, the radio stations talking about something bad they did. A good example I like to think about is something that happened there locally in Tampa with the Habitat for Humanity deals that happened to, Habitat for Humanity were offering these loans to the borrowers, and then the borrowers were non-performing, so they sold them off to a note buyer, and the note buyer started to foreclose.
Oh, yeah. I mean, actually, you can get pulled. I mean, there are things that lenders think about, liability, because you buy an asset doesn't mean that you're done. If there's some sort of something going wrong with the lender or something happening outside of just the fact that the borrower isn't making payments on time or whatever, you could open yourself up for, if nothing else, the nuisance of having to answer and deal with it.
Yeah.
And obviously, when you're factoring in your cost of buying loans, those probably aren't the costs you're factoring in. So you probably want to, make sure on the front end that you don't have any of that, and or making sure you're not creating a situation for the lender or the borrower.
Yeah, that's a huge point. Don't create a situation. You want to be coming and solving the situation. And like you said, if you've got a strong management team that can work something out better than with the previous borrowers, that's an advantage. But you don't want to walk in fresh behind the ears without really any. You may not have the history what that asset is working on, but you've got somebody on your team that can help with the transitioning or the takeover of the asset if you need to. If that's an exit strategy for you, right?
Yeah, correct.
Cool. Now, talking in today's market, there's a lot of things going, a lot of growth, a lot of build out. Cheap money is available out there for everybody with lower interest rates and a lot of this private capital that's sitting on the sidelines. for somebody who's diving into commercial real estate, let's talk, say, self-storage or parks or apartments. I'm a big believer that having relationships with individuals like you who have their thumb on the pulse, they know what's going on in the market, is a great asset to have. So you do have those pocket relationships, because commercial market is different. Whether it's the REO side or the distressed debt side, it's a I would say it's a good old boys network for the most part still in a lot of cases. Would you agree with that?
I would say that they're definitely relationship driven. I guess it's a good opportunity for me to plug CCIM.
There you go. I tried to do that softball up to you.
I am a CCIM, and I got pinned in 2013. And
Congrats.
Having thought that I knew a lot about commercial real estate, which I did from an underwriting a bank side, going and getting that designation was helpful for me to see the other side. The rounded out my technical expertise about everything, from understanding the lease, which again, if you're going to understand real estate, you got to understand the leases. How effective is the lease? How is the borrower performing on the lease, on what's there? How is the tenant performing on the lease? There are a lot of folks that have provided and created value just off of that alone. If there's a borrower out there that isn't collecting on CAM or things like that, and you can come in and actually enforce that, that's real money. You multiply that by the cap rate, and there's real value that you've created. So the CCIM designation, for those that don't know, is a designation that about I want to say last time I checked, 14,000 people have across the country. You see it a lot for commercial real estate brokers, but any practitioner that wants a technical understanding of real estate doesn't necessarily want to go back to school for another 2 or 3 years, and you want to be plugged into a network of people who not only understand technically but are doing it every day. I would recommend looking into that, because to get it, you had to take a set of core courses, some electives, and you had to have actual experience. So I think at the time I had to prove up that I had transacted, I want to say it's $10 million worth of business. Fortunately, in 2013, I'd come off of a pretty robust sale of notes, which actually qualified, in terms of the act, because really, if you think about it, in 2009, the only way to really get to some of these assets were buying the note. And so you had to have a fundamental understanding of the underlying asset, which in this case is commercial real estate, to really, get in, buy the note, and again, provide value for yourself and your investors. So, but yeah, being a CCIM and obviously being with a firm like CBRE, it really helps triangulate the information. The thing about commercial real estate is it is flow of information. And frankly, knowing people on the ground in the asset type that you're operating in is very critical. It's the leasing agents. It's the investment sales brokers. In many cases, it could be the tenants, if you're dealing with national tenants. Within your neighborhood or within the area that you're playing in, knowing who's doing what has been critical. I mean, again, in Atlanta, my clients, actually, one of them was a former broker. He's the acquisitions guy, and now it's amazing how he's been able to come in front of assets just off of knowing who's who, what's what. He's going out and having coffee and drinks with folks, developing information, and then it's helped feeding his strategy for acquisition. And now they've been able to buy assets that most people are scratching their head. How did you get in front of that asset? I would say it's a good strategy to have here. At the end of the day, in a competitive situation, you got to figure out, well, how am I going to have the edge over folks that may have the capital? And the reality is getting boots on the ground and understanding at the ground level these assets is very helpful.
Yeah, and swapping a few adult beverages is not a bad thing. There's been some rapport.
Absolutely. Not that you have to do it, but I'll tell you some of my strongest relationships that are, that have over the last 10 years and even the last 2 years have been in social settings where you're a little bit more relaxed. I mean, I think that's a good measure of relationship. If we're talking on the phone or you're coming into the office, that's one level, and it's great. But if you're at the point when you're regular having coffee or lunch or drinks or what have you, that's very helpful in terms of helping you with your strategy, acquisition strategy.
Yeah, if I remember Thursday night, you were headed into a networking event Thursday night when we talked to the phone too, weren't you?
Yeah, Thursday night after Wednesday night and leading into Friday night. I mean, it seems to be my week. So it's tough to balance, sometimes. But I mean, I think it's, for me, it's part of my personality, and frankly, it's been part of my business. I mean, from the time I've been in, on the origination sales side in any level, I've realized that relationships are important. It's the drum that you beat, and it's real, because you never know where people are going to land.
Yeah.
There are so many people. There are clients that were, folks that were in a different role in a different industry, brokers that are now working for developers or investors that are the acquisition folks or people doing projects that I didn't foresee them being in that place, but because we had a great relationship, I'm now getting those calls to help provide value. And so that's key across the board.
Yeah, definitely. Any mistakes you've made along the way that have helped you learn, if you learned from, you wanted to share? And I kind of
I think I tend to be on the edge of, what I've actually done and what I believe I can do. So sometimes I'll get out there, and that's part of being kind of entrepreneurial.
Yep.
I don't call it fake it till you make it, because it's not that you're faking, but there are many times where you might deal in an asset class you're not familiar with, but you got to get very familiar with very quickly to the level that you're giving someone comfortable that you can provide a solution. So that's where I may draw from, my own personal reading, friends that I have that might be in that asset class. And there are times where it could go either way in terms of the solution, but ultimately it does because of my comfort level and getting up to speed quickly. I think the largest mistake I probably made was not personally buying back in 2009.
Don't we always do anymore?
I literally, when I look at Tampa and, as one example, and some of the cool things that are happening here and are being developed here, I can point to the actual note. Oh, I sold them this or sold them that. And, it's great because I think I've got, friends for life in some cases because of the value, just being at the right place, right time, and just happening to sell and seeing their strategy and how they're now developing out of that. I think you can't help but, if this comes around again, being in a position to be a purchaser. So I'd say that's probably the one mistake. Even housing, what I'm paying, I did not yet buy down here, but what you're paying for rent in 2009 and what you're paying for rent today, two different numbers.
Yeah,
same thing with buying.
Yeah, I got a buddy in Houston who said, "Hey, if you thought real estate was expensive 5 years ago, wait till it's another 5 years from now." You know what I mean?
Absolutely. I mean, and I guess there's no better time than now. Probably the advice that comes out of there. I mean, there's always going to be a reason not to buy. There's going to be a reason to buy. If you're going to do it, just obviously develop your strategy and just go do it.
Yeah.
That's probably the one mistake. I wouldn't call it a mistake because I liked where I landed and having seen that. But man, if you were buying anything in 2008, 2009, and you're not, fully creating value or have already developed value by now, something's wrong. I mean, everyone seems to be come up.
Yeah, I went and sat in with a couple of the asset managers from Regions Bank in different parts of the country because they didn't have an online portal or anything. They had a large 3-ring binder with all their commercial assets.
Right.
And going and meeting with them, like, okay, I got a 1-page thing on here. Is this all you got? Yeah, go take a look at the asset and come back to us. I'm like, this asset's in North Carolina. This one's way the hell across the state,
Right.
But those were the opportunities. And if you we made some great deals happen out of that. But I had the same thing. Damn, I wish I'd bought a whole lot more.
Right. I mean, there was not enough money. I mean, when you just kind of, obviously, the rearview mirror, is 2020, but I think that, and then I guess that sets it up for if there is a dip, in the future, understanding the best basis to buy an asset. What is it the cost to rebuild? What is the best price per pound, just generically, and then going into the weeds on the particular assets that you're looking at. There's a strike price that just makes sense no matter what. And then you just got to factor in, all right, well, what does it cost to actually get to the asset, meaning the underlying asset, and then what's the carry? And if you can, factor those in and you're right there, then generally speaking, there's some return to get.
Yeah. Now, being in Florida, Florida has got one of the largest numbers of mobile home parks in the country, affordable housing. Not only on, I'm sure you see a lot of the senior housing, 55 plus communities out there pretty easy. Are you seeing a lot more of those communities that aren't just 55 plus, but springing up across the state or the south part of the country for the most part?
Yeah, I personally have not done much in the mobile home park space, but I hear about it. And frankly, what's happening is a kind of a refresh. Historically, mobile home parks have been known to have very strong cash flow.
Yep.
Not like a ton of CapEx per se, because you're dealing in many cases with the lots and the dirt. There are some springing up, and I think that in terms of being creative about affordable housing, you can't not look at mobile home parks.
Yeah.
We're starting to see folks look at shipping containers as a form, prefab, whether it's mobile home or, any kind of prefab construction. I'm starting to hear about innovative ways there because costs of labor and materials are continue to go up. And so I think that overall, the aging, 55 plus active communities, whether it's a house, whether it's multifamily, whether it's senior housing, ALF, mobile, I think are all going to be important down here as people continue to move here.
Yeah, I think so. I think you're hitting the nail right in the head there. We're starting to see here in Austin too, with the expensive cost of living. It's expensive, most expensive in the state here right now, and the lack of inventory. We're starting to see on the outlier stuff, people are taking those shipping containers and turning them into apartments. I think the guy, I can't remember his name, but he originally started Zappos. He built a commercial spot there in Las Vegas as an incubator for new entrepreneurs. It's a 2-3 story thing, just a shipping container, mini offices is a unique,
Right. Yeah, and it's funny you mentioned Vegas. I'll be going out there in a couple of weeks. That is another market that is on the rise. Obviously, they've got the football team. They now have a women's basketball team. I wouldn't be surprised if some other sports, the hockey, some other sports. It's becoming in and of itself outside of the strip, increasingly of interest, if you will, particularly for people moving out of California.
Yeah.
And then you've got, again, affordable housing. You got people that live on the strip or work on the strip rather. And, immediately next to the strip, it's, they don't necessarily have the quality of housing that you would see in other markets. So you're starting to see a little bit more interest, in Las Vegas, in and around downtown Fremont, and kind of just outside the strip and finding and creating housing there. So I've also heard the same about Scottsdale and Phoenix. If you notice the cities we're talking about, they were all the cities no one wanted to touch 10 years ago. They were ramped up in 5 and 6 and were really hot, and a lot of the home flipping and whatnot. It really was kind of the Sun Belt in Florida. And now when you look at all of those cities, even Fort Myers, for example, there are now fundamentally people starting to move there outside of just the construction industry, and there's starting to be economies developed there and real housing need for those markets and those towns.
Yeah, if you look at Fort Myers, Marco Island has always been the most expensive aspect of it. Naples, you had so many realtors in Naples that won't even draw across the bridge to sell a house in Marco, or vice versa. You know what I mean?
Right. Correct.
That area is one of the hottest areas in the country. People moving to, it's Collier, Lee County, very wealthy, areas there. But it's growing. It's one of the hottest areas. I bought a lot of distressed debt and single family homes there and rode the values up and sold them, and always looking for good deals in the neck of the woods too. So
yeah, for those that haven't been, Naples is a pretty good town. I had the choice between Tampa and Naples. I chose Tampa. It's still very much kind of has a retirement feel to it, but there's a lot of wealth. People are tearing down $1 million homes to put up multi-million-dollar homes in Naples, and The challenge there in terms of housing is you're either going north because it's, got the water, you're going north into Fort Myers and Cape Coral, or you're going east into Immokalee, which is right kind of in the middle of the state. Actually, there are people who work in Naples and or even Fort Lauderdale. Because of, it's so centrally located, it's about an even drive between the east and the west coast of the state. So you're starting to see, and it's not just there, actually, they're redeveloping the roads just because of the sheer number of people, the toll roads and the highway. They're starting to look up the middle of the state. And there are places like, Gainesville, Tallahassee, between Tampa and Orlando, you've got Winter Haven and you've got Lakeland. That have been kind of small towns, but increasingly with the number of people are becoming bedroom communities for, Orlando, Tampa, Southwest Florida, South Florida, and so it'll be interesting to see how the housing need for communities like that develop, or the supply rather develop over time.
Yeah, you're 100% correct on that. You look at what's going on, like Celebration, Davenport, the growth out that neck of the woods. It's a 20, 30-minute drive to Ratland, as I like to say. But they've got the space to grow, whereas Orlando is really kind of it's gridlocked a little bit. I mean, I think Orlando, for a major city, has one of the fewest apartment complexes anywhere in the country. You don't see that much. You've got to be outside of the city for the most part, right?
Correct. And interestingly enough, in and around downtown Orlando is growing. There are a lot of UCF is actually starting to have a big presence in downtown. There are redevelopments happening there. I was at a conference. This is back in the spring in Orlando, and there was a multifamily developer on the panel. There's always a question: is there too much product moving online? And when you talk to most multifamily developers in Tampa or Orlando, they say when you look at the sheer numbers of people moving, absolutely not. Actually, they're getting to the point in Orlando where they're going to like old D&C hotels and renovating them to create some affordable housing. So there is a sheer need of housing that's not going to stop. I mean, even when you look at what happened with the storm last year, a lot of people from Puerto Rico that now have relocated to Orlando. So I don't think that's going to stop. And Orlando uniquely does have a lot of land around it. And it isn't quite like Atlanta yet, but you can kind of see how over time the development will happen, around the city because of the availability of land around it.
Yeah, and I think that's a big reason why Jacksonville has come on strong. I mean, Jacksonville is really the slowest market in Florida as far as the major cities to really rebound, which is kind of surprising being so close to Georgia and that neck of the woods, but it was the slowest one to come back, but I think it's still the most affordable buy in Florida for the most part.
Yeah, I think so. I mean, most of my time, and fortunately, when I was in, note sales, we had assets all across the state. So I've personally spent time in Jacksonville and, all of Southeast Florida, really the whole state. In Jacksonville, it still has a lot of runway, particularly for growth. It's got a lot of industry. It has kind of the financial services sector. It still kind of, to me, feels it's a big city, but in many ways it's still a small town. And so I think over time it's just behind the Tampa, Orlando, but has just as much of a trajectory, particularly for people that like the seasons, that don't necessarily want to have. It gets pretty cold up there, and in some cases, I think, depending on how north you go, you can maybe even see a little bit of snow.
Yeah.
But in my experience, a lot of the growth has happened kind of 95 JTV, kind of quarter on the east side of the city. And then you've got Ponte Vedra, and of course, you've got the beach up and down, all the way down to St. Augustine. It'll be interesting to see, where they come out. But the folks that I know up there are just as many projects in and around kind of downtown that are happening there as well. So just a little bit behind the curve, but still growth nonetheless.
Yeah, and it reminds me a lot of what we were talking about earlier about Vegas, Phoenix, Scottsdale, whereas a decade ago you'd have a $300,000 house you could buy for $30,000. And there was just such a gluttony of inventory in that neck of the woods, and it took forever to rebound back up. Jacksonville was also had a lot of lower value houses compared to other parts of the state. It's kind of coming back up full force and things. I wanted to ask you, are you seeing, because I know in 2005, 6, and 7, one of the things we were working with a lot of was taking existing apartments or even some hotels and putting a little value add into, get them an individual meter, and then putting them into and doing a condo conversion. Are you starting to see a kind of a rebound of some of those across in some of the different areas of the country?
Yeah, actually, yes, not as much down here in Florida, just because there's such a need for units, and I guess the rents are such that you can pencil development.
Yeah.
But in Atlanta in particular, I have a client, back in October, we financed or I helped them arrange capital for a 50-unit condo conversion into condos. It was like a 1920s vintage in Buckhead. And if you know anything about, Buckhead, a lot of wealth there. And frankly, any of the new projects coming out of the ground were at least $500,000 or closer to $1 million as far as, buying a unit. These guys were able to find and currently are selling units somewhere in the high threes, mid to high threes, low fours. I mean, it was a very good timing and good place in the market. And to my knowledge, they might have been one of the first 2 or 3, and no less than 6 new projects since then have been announced in different areas of the city. Interestingly enough, I just kind of heard that cities like Chicago, where you've got dislocation of rent and buying of units, you're actually decondoing condos and going back to apartments.
Yeah.
So I've seen that, but for some of the cities up north that are older cities where you've got just the need for rental and the rents are supported, and you've got a lower basis for some of these units. From my understanding, I think if you can get 80% of the units, control the units, I think the whole building has to go. And so you're starting to see, investors are going out and assembling units and getting a critical mass and then turning them back into apartments. So again, creative strategies across the board to figure this out have been kind of fun to watch.
Yeah, we did a project. There was a 24-unit apartment complex here in Austin that was near the law school, University of Texas. So for $5,000, we got the city to redraw up the do the condo conversion for us. It was already individually metered, so we didn't have to do a lot of extra work to it. And then went to each of the tenants and said, "Hey, you want to buy? You want to own this unit?" So instead of collecting roughly about $800 to $1,000 in rent, and we bought the whole thing for like $250, so it was like $25,000 a door. We were able to go back in, resell them at $70,000. Most of these people had their parents put 5% down, so we did a 5%, an 80% first, and then a 15% second. This is right before the crash. So we were able to sell the first liens off at 90 cents of UPB in the first, kept the seconds for holding costs, and made a ton of money.
Yeah. I mean, some of the other things just kind of cutting edge that I'm seeing that might be of interest to people listening. Single family communities for rent. I mean, one of the things that we saw where there was a lot of Blackstone, a lot of institutional buyers out there, particularly down here in Tampa, actually, as an example, were buying a lot of the busted master plan single family home communities, ultimately had a critical mass and figured out the operational aspects of it, and now they're a lot for rent. Now, obviously, it could be a covered land play where at some point maybe there's a redevelopment or more feasibly, a sale of the single families back to consumers.
Yeah,
get a higher price than where they bought them. But now we're starting to see where land is being bought, and particularly in places like Austin, where it's becoming expensive to rent in the city. Developing whole communities just for rent.
Yeah.
Another thing we're starting to see, or I'm seeing a lot, or increasingly, is Airbnb strategies or apartments, single-family homes, and finding the right mix. Even allowing, and a lot of this is going to be tempered by regulations, and even either with the city or municipality or within the community. A lot of condo communities have restrictions. But if there's some developers that control, a whole apartment building or enough of a critical mass of a condo where they're not only allowing, in many cases, there might even be advertising that, you know, if you buy this unit or if you rent this apartment for some sort of fee, you know, permit, license, what have you, you can Airbnb the unit. They may even help, you know, with the management.
Yeah.
So when you look at the value and you look at what a unit getting a rent, normal apartment rent versus what you could get on an Airbnb, it could be pretty lucrative. But then again, the other side of that is what happens with housing, because ultimately those units then come offline, you know, are no longer available for housing. So could compound that problem. I don't know if it is something that is going to be done in scale, but it's pretty interesting to see it done, or at least on a small basis.
Yeah, there's both sides of each equation. Like there was an article in USA Today, either yesterday or this morning, talking about Sedona and how a lot of the community up there is upset because it's become such a short-term rental community compared to being long-term owners, you know, and longer-term rentals versus, like, you know, night. And then you also look like in Austin here, the city was dead set against it, Airbnb, so they booted Airbnb out for a while, and it started to come back in. But they're also working, you know, people are still doing it, and the city's hiring outside firms to go track these people down that are doing it illegally and cracking down on it. And, you know, people are like, hey, this is how I pay for my mortgage, is by renting my bedroom or renting the couch out if I need to, you know?
Right. Well, the reality is people want it. I mean, at the end of the day, I think, you know, municipalities have to figure out, you know, how to ride the wave, obviously extract their fees, taxes, et cetera, so that they benefit it. And, you know, obviously in some cases there could be negative impact that you want to kind of, you know, moderate and control. But, you know, anymore, again, going to kind of the current generation, people want optionality. People don't necessarily want to own, they want to control and have access to and use, but don't necessarily need to have and own. So that's, you look at cars with Uber, you look at, you know, Airbnb as an example, you know, figuring out how to find, you know, cater to those folks. I mean, there's a set, I was one of them for a few years where I paid rent, but I was never home.
Yeah.
It would be better for me to find some network or an Airbnb or something like that to create value for me, in that I'm spending this money that I'm not really getting use of, and I'm using, you know, paying over and above in hotel fees or whatever else, and I'm not home. So all of those are real needs, and it takes an entrepreneur sometimes to figure out how to solve it for those folks.
Yeah, I think you lived a scene out of Up in the Air with George Clooney, right?
Pretty much. I mean, I think the other side of that is financing. You know, right now, it's tough to find permanent financing for an Airbnb strategy, primarily because Freddie and Fannie and FHA are all around housing, as they should be. And the private market hasn't yet figured out, or I haven't seen a lot of products out there that cater to this set. And I think the ones that do, there is a niche right there that is going to be lucrative, because when you look at the difference between the NOI as an apartment and the NOI short-term rental, I mean, it's night and day.
Yeah.
I think whoever does it, it's going to be looked at somewhere in between a hotel. So while you can get high leverage and high assumption of vacancy in an apartment, in a hotel you can't. You're typically around 85% occupancy at any given time, in some cases less. So you wouldn't necessarily get credit for as much as you would for an apartment, and you may not get as much leverage, you know, typically around 65% leverage. But when you look at, you know, how much you're getting, it may be better to have a conservative financing strategy, because you're getting so much more value out of the property by doing the short-term strategy.
Yeah. Are you seeing, and I know we're seeing this here in Texas quite a bit, and I think this may be the same in Florida and other areas. Are you seeing a lot of the smaller chains like the Candlewoods, the Homewood Suite hotels popping up, people coming and building those up? I mean, because there was a glutton of hotel debt on the market years ago. I hadn't seen much of it recently, but I am seeing a lot of those. I mean, I know several hotel operators, owners, that are like, yeah, I've got an extra couple acres. I'm going to convert half the parking lot into another hotel and build up.
Yeah. I think, well, I would say Tampa specifically is probably under hotel, believe it or not. You know, we have things like the RNC that was here. You've got the national championship was here a couple of years ago. Super Bowl will be here next year. When you got major events like that, people were going as far south as Sarasota because there wasn't enough rooms here. Obviously, Airbnb kind of helped with that as well. There are a lot of hotel rooms being developed here. In downtown, the Marriott here is being revamped. There's a JW Marriott being built. There's an addition. There's a lot of boutiques out there. To your point, it seems to be, brands like the 21Cs out there, the Autograph Collection. A lot of the majors are now going to kind of boutique, similar to how I guess the big breweries are buying these boutique, brewers. You're kind of seeing that in the hotel space because, again, people want a unique experience for their set. And so there are a lot of brands kind of revamping around that. A lot of the limited service, PIPs are due. And so it's a good opportunity. What we're seeing is people are buying hotels and, go ahead and taking care of the PIP and whatever the cutting edge for that particular brand, whether it's IHG or Marriott or Hyatt or Starwood, revamping that. Sometimes they're going with a new flag.
Right.
A friend of mine in Atlanta was telling me that there's, even like the Radisson, which I hadn't heard in a long time, is really trying to make a comeback in some of its products. So I think anymore, because of Airbnb, it's pressing, hotel community to be very creative to make sure that they're providing the service for different pockets of clients.
Yeah, definitely having the we've seen that everybody's trying to have restaurants or having some sort of 24-hour service, room service. They're really trying to draw on other ways because hotel space, to put on an event, hotel space has gotten ridiculously expensive. It's exponentially grown. Vince, and that's part of the reason we led to doing away with doing our hotel events and doing more online events. It's much more affordable for everybody else to be there and be present from the comfort of their own home or office,
Right. And, travel takes a lot out of you. I mean, the time spent on a plane or in a hotel or, is on top of whatever meetings you have or whatever business that you need to take care of when you're there. So it's anytime clearly we're on Zoom now, this wasn't here even 2 years ago, and so because of that, there are those out there that believe that in general, hotel might, there might be some opportunities in the hotel space just because it's over more units. But I think that really is based on by market. Anywhere in Florida, as long as there's not a hurricane coming around the corner, people are going to always want to come here and vacation and now increasingly visit, grandparents or family and whatnot. So obviously there's a lot of just about every brand here. And then, depending on where you are in the country, everyone's kind of stepping their game up to make sure that they capture those consumer dollars.
Exactly. All right, I got a couple questions for you. Totally off the wall. If suddenly we waved a magic wand and overnight you had a $25 to $50 million fund, okay, what areas would you be at? Where would you be going and spending your money?
Geographically or asset type?
But
I would be exactly where I am. I would be in Tampa, Orlando, Southwest Florida. I would be up in Atlanta, Charleston, Raleigh, and Charlotte, looking primarily at, I like housing. I think finding and creative ways to provide rental housing that has amenities, that is amenitized, that is not too expensive. I think overall, if you can create a brand around that and do it in a way that is cool and unique than what everyone else is doing, I think people will pay attention. So I would do that. I would probably I would put some of that money with friends and clients of mine that I see, that I know and trust, that can execute on their particular strategies. Now, I would partner. Having the capital, I would, whether it's storage or whether it's multifamily or whether it's office, I would not necessarily need to be that person, but partnering with that person is enough to get value for the funds. But me personally, if I'm doing it myself, I like in-town urban strategies because it just seems to be where the wind is blowing. It's for the foreseeable future. That's where the growth is. And I think combining aesthetics with the economics with relationships, if you can figure those out, I think sky's the limit.
Yeah, that's a great answer there. Two parts. One, on things and then also on reliable people that are operators doing a great job themselves, being the money behind the man is a great play as well.
Correct.
Now, for our listeners, people that are watching this, is it feasible for them to reach out to you if they're working on projects or have got some true viable assets in some of these areas that you mentioned to run you by there? Or do you stick to what you're doing in business in Florida, or what's your kind of your footprint?
Well, I started off personally with a Southeast strategy. So that's the Carolinas, Georgia, Florida. So if someone's doing something in those states, by all means, would love to talk to them. I tend to limit that though with specifically commercial real estate. And generally speaking, I'm dealing with a loan or check size of $5 million and up.
Yep.
There is a huge opportunity for the 1 to 5. And I am increasingly seeing entrepreneurs and funds kind of target that space.
Yeah.
You can imagine you don't have economies of scale, but you do have a lot of volume in most mid-sized and small cities. And but in terms of where I'm personally transacting and helping folks today, is generally $5 million and up. It is every aspect, whether it's buying dirt, whether it's a value add strategy, whether it's a construction strategy, and then obviously permanent financing. Happy to help. Good thing about being a CBRE, it's a global company.
Right.
Our structured finance team, part of how I look at myself is like primary physician for a client. What is it that you need? If it's something that I can run out, I will. If I need to bring in a specialist, whether it's in the market, right now I'm looking at some opportunities where I may be pulling in clients from Texas, for example. I closed a loan in Las Vegas for a client, and I partnered with, my colleague in Las Vegas to be able to do that. I think that generally speaking, obviously being in a platform where a lot of the research is, where a lot of the professionals on the ground sit, just makes it helpful for me in providing solutions and helpful for the client. Anyone that's doing, less than $5 million, my best advice would be to get to know all the community banks. That's evolving as they're getting acquired. There's a new one being popping up every day, it seems like. I would also get to know some of the shops like the Coldwell Banker commercials, the KW commercials, some of the smaller mid-sized. Marcus and Millichap, for example, plays a lot into that private client space.
You're right.
Depending on what it is that you're looking to do, develop relationships with those people that kind of play directly in that space. And I would say reach out to a CCIM. Again, a plug for that. If you had nothing but a team of folks that had a designation, I'm confident that they would be able to help you, advise you on your strategy. And generally speaking, a lot of my really good contacts, whether it's attorneys, brokers, even potential clients, are CCIM. So that's just a great network that I can work with nationally. Awesome, man.
Anybody else? Anybody have some questions, or before we let him go on his merry way this Sunday afternoon? I know you're probably getting ready to have that mid-afternoon shower in Tampa.
Actually, it's going on right now as we speak. I'm sitting here looking at it, and it looks like the sun out is somewhere, but it's sprinkling right now. So good timing.
That's awesome. I'm going to be out in that neck of the woods end of September. I'm going to give you a phone call up to grab lunch or go kick back a few.
Absolutely. No, it's been a pleasure. Thank you for reaching out for me to doing this. Hopefully I've added a little bit of value to your listeners. And I'm on LinkedIn. So
hey,
very active on LinkedIn.
Profile photo on
Yeah, absolutely. I'm waiting on my headshot. Hopefully I get that in this week, but I don't look a little bit heavier than that. Than I do now. But
I think you change your email in there too, because I think your email's out of date there too.
Is that right? Well,
yeah, I sent an email there and it bounced back, and that's why I sent you a direct message on LinkedIn. So
yeah, I've got it was my twin pillar email. I'm yisrael@ccim.net, yakhin.israel@cbre.com are the two email. But I am fairly active on LinkedIn. I think that's how we reconnected. Not always immediately responsive, but generally speaking, that's kind of it's been pretty important and a pretty big platform in the commercial real estate space. So
I'm into that, man. Well, hey, man, thanks so much. Such great nuggets, a lot of value, everybody here. Seeing thumbs up, people really enjoying it, and I enjoyed it. So that's really all that matters for this one for the most part.
Well, thanks again. Let's do it again sometime. Give me a shout when you're down here in Florida.
Hey, we'll do, bro. We'll do, man. Enjoy the rest of your weekend, all right?
Thanks. You do the same.
Bye. All right, hey, that's going to wrap it up for this session of Note Camp Commercial, everybody. We're going to take about a 17-minute break, 18-minute break. Let you run, grab a cup of coffee, cold beverage. It is Sunday. It's almost 5 o'clock on the East Coast, so hopefully you can pop a top. I'm totally fine with that if you want to. But we'll be back with Garrison Gilbert, who's one of our students who's gone out and done some amazing things, transitioning from the residential space into a lot bigger projects and doing some great stuff. So stick around, and guarantee Garrison will drop a lot of knowledge as well. See you guys in 17 minutes.